Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Lara Rhame of FS Investments is with us alongside SocGen's Subadra Rajappa. Lara, let's start with you. Your reaction to this data, you've had 5 minutes to chew over it. What stands out for you?
So, we've had now sort of 4 months of unfriendly inflation data and growth really continuing to surprise to the upside. Today's got to be a huge relief because some of the early numbers for April were really confirmed by this broader look and this broader data. So, this is a more dovish report. I feel like you have to acknowledge that. I do notice the slowdown in spending, especially the real spending. We're starting to get data for Q2 and, you tease that going into this, but we had still peeling back the headline number of Q1, the underlying data was fairly strong. I think we're now waiting to see how Q2 shapes up. So far, it looks like it's also going to be a little bit slower. I think the landing may be really sort of orchestrated in Q2.
Subadra, is that landing in sight?
We think that the Fed's going to stay on hold for the remainder of the year, and this data point doesn't really push. There's no sense of urgency, I think, from the Fed. With the inflation starting to ease up, growth is starting to come down. But we heard from Williams yesterday, and he's expecting growth in the context of 2 to 2.5% for this year. Inflation, core PCE heading towards 2.5% by the end of the year. There's really no urgency for the Fed to cut rates anytime this year. I would say the earliest that we were looking for the Fed to cut rates is after the elections at the December meeting, if the data requires them to do so.
But Subadra, on the margins, given the fact that this isn't necessarily a game changer, but that it does confirm this idea that maybe the disinflationary trend is back on track, does that give you more conviction, actually, with some of your closely held beliefs, this idea that you should buy bonds, particularly the longer end, and that inflation will come down and that we will essentially normalize?
You can buy bonds in the long end, but it's really much more attractive to hold front-end treasuries because the yields are way more attractive. And that's exactly what you're seeing in investors. I mean, you're seeing AUMs in money market funds at $6 trillion. Money is going into the very front end of the yield curve just because returns look very, very attractive and the yield curve is inverted. And I think that trend is here to stay until we know that the Fed is going to be cutting rates aggressively. And this is really when it gets a little bit tricky for me because you look at the policy path that's priced in the markets. You're looking at, very few cuts between now and the middle of next year. So you're looking at less than 100 basis points of cuts by the middle of next year. So that still argues for investors to continue to plow money into the very front end of the yield curve, not so much in the long end.
Lara, this raises this sort of larger question, which is, does it really matter if the Fed cuts rates once, right? I mean, this is the issue that we have with the ECB as well. Are people looking for evidence of a real slowdown that could lead to a protracted rate cutting cycle? Based on what we're seeing now, does this data go anywhere near beginning to move us in that direction?
Yeah, and maybe I'll take that question in a slightly different direction because I agree, 25 basis points, especially given where we are at, over 5.25, is not going to move the needle tremendously on interest rate sensitive sectors of the economy. I think the question to me is, we're probably not focused enough on growth, which has been so strong at 3%. Expectations of higher growth are now so built into markets. Nominal GDP growth of 6% turns out is enough to power equities higher, even though rate cut expectations have been ratcheted very far back. So going forward, if that slows to 5%, this isn't a big slowdown, but I think, we need to pay attention to the fact that so much growth is priced into earnings expectations, and there's so much optimism priced into markets. The two-way risk on growth numbers are now really significant. We haven't seen that in a year and a half.
Lara, before we run away with the conversation about growth, can we just sit on inflation just for one beat longer? You've been saying for a while that we'd get stuck around 3%. Are you rethinking that?
I'm not. I still think that at the end of the year, we're going to see inflation pressures continue to creep back up. And I think we're going to see the inflationary process really stuck around 3%. I don't think that stops the Fed from cutting if the economy slows a lot. But I think it makes it very hard to maneuver in a place where we're still growing at 2.5%.
Mohamed El-Erin's been on this program and he talks about stagflationary wins. Lara, are you thinking about stagflationary wins at the back end of this year?
You know, today the economy looks really solid. I'm not too worried about it because business investment is going to ratchet back up again. I think we're in a good place for the economy. I'm trying not to overthink it too much.
Subadra, are we overthinking it? When you say no rate cuts this year and you're looking at inflation, what does growth look like at the back end of 24?
Probably going to gradually slow down as we progress through the remainder of the year. We're not overthinking it. I think the simplest path is for the Fed to stay on hold for the remainder of the year instead of kind of the conundrum that the ECB is in right now where, you know, the market's pricing in for a June cut. And then the debate on whether they're going to cut again in July, whether they're going to cut again in September. So the sort of volatility of expectations is really what's confusing investors. So to me, a very straightforward path is for the Fed to stay on hold for as long as they possibly can, and then embark on maybe a cut a quarter or some sort of a very stable, steady path of rate cuts from then on, as opposed to this back and forth.
Laura really raised this two-pronged idea of both inflation and then this idea of growth. And what happens if you start moving out of the inflation being offset by strong growth to maybe not stagflation, but inflation not being offset as much? Subadra, does that make you, if there is clear slowing in growth, clear growing in spending, a little less sanguine about riskier securities within fixed income just because you both have rates on hold, still enough inflation to make the Fed nervous, but an economy that just doesn't have the same kind of juice in it?
Yep. Because of that, that's one of the reasons why we think that across the yield curve, yields are going to struggle to get above that 5% level. 2-year above 5% is going to require a much more different stance from policy. The Fed either has to hike or not cut for the next couple of years. And for the 10-year to get above 5%, the market is always going to be looking towards growth slowing down in the second half, and that's really going to cap the rise in yields. So even though we've had these discussions about R-star and whether R-star is a lot higher and whether debt and deficits start to matter, I really think that the focus, at least for the second half, is going to be on the slowdown in growth, and that's going to really cap the rise in yields. 10-year yields are going to struggle to get to 5% this time around.
Where are you on the R-star debate?
There's a case to be made, and I'm very sympathetic to the comments we've had from both Bill Dudley as well as Lori Logan that maybe R-star is a lot higher, at least a short-term R-star might be higher than what we're hearing from Fed President Williams. But the question is, how can the Fed actually act on that? Because what they really need to see is the data support a higher R-star. So we'll find out in maybe 3 to 4 years where R-star is today. It's really hard to know where it is right now as it stands.
And Lara, this sort of goes to this framework of it's hard to know where the end zone is going to be, also just in inflation. As Jon was mentioning, you think inflation is going to remain stuck at around 3%. What would you have to see to rethink that? We have Neil Dutta coming out this morning with a note after this data came out, just saying, every month this year has seen month-over-month core inflation lower than the same month in 2023. What happens if this pattern holds into the summer? Is that something that could make you rethink this idea of 3% as sort of the sticky spot for inflation?
I think, to me, the problem is that we really we don't remember how much everything had to go perfectly to get inflation at 2%. Today we've got commodity prices really moving higher. I think rents are going to reaccelerate. Ironically, high Fed, really restrictive Fed policy has stopped home construction, which is what's needed to help, unravel this whole real estate sort of stagnation and the stuck at higher prices environment that we're in. long story short, when you put it all together, we may well, see inflation dip a little bit lower. But I think my forecast is a longer run problem of stubborn inflation above 2%, kind of the mirror image of where we were for the 5 years before COVID, stuck below 2%.
I always feel like Neil's regulating us, don't you? They always feel personal, those emails.
Totally.
Sent them out to clients, just saying.
Yeah.
I feel like they're sent to us directly.
It feels like he watches us and then screams to the screen when I speak. Like, you have no idea what you're talking about, Bramo.
Just saying, which is basically what he's done on this programme before.
That's why.
They're both friends, apparently. I kind of believe that. Let's look ahead to next week. ECB next Thursday. Then we get the payrolls report. In our survey right now, keep giving you a sneak peek. Here's the latest. 180,000 is the median estimate in our survey. Previous number, 175. So, Subadra, can we talk about next week, both the ECB and a payrolls report? And let's start with payrolls, and we'll finish on the European Central Bank in a couple of minutes. What are you looking for from that report next Friday?
So our economists actually have a slightly higher forecast, if you will, for payrolls than the consensus. So I wouldn't be surprised if you get a 200,000-ish number. The unemployment rate is going to stay below 4% for perhaps the remainder of the year. So very strong employment report is again what we're expecting for next week. But if there's any misses, that's when the market's going to react. The market's going to shrug off an upside surprise, I think.
Lara, do you agree?
Yeah, I agree. The market seems to have happy ears right now. They want the rate cuts. That's the news that they react to more than, anything that would sort of push those back. At the end of the day, when we look ahead to rate cuts and when that could happen, we're starting to push up against the election calendar. I think we're just going to kind of give up the ghost slowly on a rate cut before the election and really focus on those December, maybe November meeting.
I'm not sure down investors have happy ears, but I get your point. Lara Rhame of FS Investments. Lara, thank you for that. Subadra, I just wanted to give you the final word on the ECB. Big conversation around this table about central bank divergence. The limits of that divergence, how far can this ECB go without the Federal Reserve?
So I think our European economists said it best, which is it's data independence. I mean, the Fed and the ECB is already committed to cutting rates in June, and they're going to do it, even though the inflation data that we got, recently doesn't really justify them to cut rates in June. The question really becomes what comes after that. And to me, what really dictates the price action in the bond market is this divergence between the ECB and the Fed. I think that's going to keep rates between the U.S. and Europe diverging as well, because the Fed's going to stay on hold for the remainder of the year, and the ECB is going to still be biased towards cutting rates.
We came into this week saying it was going to kind of be a sleepy week. You could make your argument about whether it was or wasn't, but next week is going to be actually massive when it comes to both the JOLTS data, the payrolls. We've got, of course, the ECB.
You're excited about
Thursday.
next week?
I am excited. Yeah, I'm excited.
Okay.
So I just want to know what you're most excited about of all of these potential data points. The ISM data, we get manufacturing and services.
So I'd start with JOLTS. I mean, if you look at the job openings, we really want to see that head towards that pre-pandemic level relative to the number of unemployed. So that's a very important first metric on jobs. Beyond that, I'd be looking to hear from the ECB and what they're thinking about policy, not just for June, but beyond for the remainder of the year. And then payrolls. Payrolls is very, very important. And whether we keep that momentum that we've had throughout this year is going to inform us on whether the Fed is going to look at perhaps cutting rates in July or September, which is not our base case, but that's something that we'll be looking towards. The Fed really wants to see the job market cool off as inflation is coming down as a justification to cut rates, and they want to see that data soften.
We are hitting the ground running in the month of June. Sam Stovall of CFRA writing this. It's been rumoured that between Memorial Day and Labour Day, investors focus more on their tans than their portfolios. The S&P 500 gained an average of only 1.6% in price between these two holidays since 1945. Instead of experiencing the summertime blues, it frequently enjoys a summertime snooze. Sam joins us now for more, and hopefully, Sam, you'll wake us up a little bit more than that. Sam, what are you advocating for then for clients through the rest of this summer? To sit back, chill, and ignore everything?
Well, good morning, Jonathan. I think certainly there's a lot of reasons why one might say that this Memorial Day through Labor Day period might be quite different from other election years since World War II. Certainly now we know that AI has been driving tech and semiconductors, but EI has really been driving the rest of the market, EI being earnings and inflation. And now with the worry once again that the Fed could be raising interest rates, possibly staying higher for longer, causing a recession, I think that's what's, in a sense, causing cracks to form underneath the confidence of investors today.
So does that mean that, Sam, you think that people shouldn't go try to tan and they should actually be in the office actually trading because otherwise they could lose their shirt?
Very good, Lisa. I like that one. No, I think that what we typically find is that many of the groups, while they do tend to tread water, investors do tend to gravitate toward the more defensive areas of the market. I always say that you are much better off rotating than you are retreating in this traditionally staid period of the year. And it's usually those areas like staples, healthcare, utilities, et cetera, that have done well. But I guess this time around, what we're seeing is that since the Dow hit 40,000, really there's been no place to hide. The market really has been selling off quite a bit, with technology being the only group that's still in positive territory.
And it seems like any kind of miss or even in line that isn't necessarily off the charts for some of the biggest winners this year have been punished severely in terms of market reaction. I wonder if there's a larger takeaway, though, and we were exploring this yesterday with Peter Oppenheimer of Goldman Sachs, that at this point, at this level, based on how much yields have moved up, that is going to be the tail wagging the dog when it comes to the equity markets. If the further that yields go up, the more punitive it becomes for the stock market. Do you believe that?
Oh, yes, because I think that's the real factor that is causing concern. I mean, our expectations had been that we would see a gradual decline in the 10-year yield as the year progresses. And so obviously with it going in the opposite direction, that makes us sort of second guess our own opinions. And I think the same is being done by other investors. So our belief still is that the Fed will be cutting twice this year, September and December, obviously knowing that now September is more like a coin toss as to whether that will happen. We also remind investors that every election year since 1992, except 2012, had the Fed either raise or lower rates prior to the election, many times occurring in September. So I think the Fed would love the opportunity to show that they are apolitical should the data allow for that.
Sam, if September's a coin toss, what does the Fed need to see in the data before September to have that confidence to cut just before an election?
Well, I think they're going to have to see today's PCE and successive PCE indicators show continued downward trend. I think we're likely to see the unemployment rate maybe tick up a couple of basis points, and also just see that maybe the second quarter GDP does not come in as the Atlanta Fed is anticipating at this point, well above the 3% level. So I think the Fed is basically going to be sticking to its mandate by saying, can we see inflation come down while not having a material impact on employment?
Sam, I just want to take the conversation, finish this conversation somewhere where Lisa's been leaning, and I think it's an important conversation. What's happened with Salesforce in the last 24 hours? Down by about 20%. What happened with, say, Dow down by about 15% in pre-market. The Dow numbers, to Lisa's point earlier this morning, they weren't terrible. In fact, they were a beat. It just wasn't a big enough beat, and you're seeing a monster move in quite a sizable company, Sam. And I'm wondering from you and the team at CFRA, the kind of signal that you're taking away from this kind of price action.
Well, I think, as Lisa was saying before, that companies are being punished if they don't meet the published numbers or even the whisper numbers. Technology for this first quarter is showing a 25% gain in earnings versus the earlier anticipated 20% rise. Also, we've seen an improvement in not only 2024, but also 25 estimates, now 20% for the sector in 2025. But it continues to bump up against the 30 PE for the sector itself on forward 12-month earnings, which has resulted in pretty much a locked ceiling, if you will. And so with these numbers really at stretched valuations, I think there is the need for the resetting of the dials, at least in the near term.
Certainly seeing that as some single names, that's for sure. Sam Stovall there of CFRA. I'm pleased to say that Bloomberg's Guy Johnson is joined by Delta Airlines CEO Ed Bastian in Dubai. Guy Johnson, over to you.
Jon Ferro, thank you very much indeed. Yep, Ed Bastian here in Dubai. Tonight he's going to receive the ATW 2024 Airline of the Year award. That's why he's here. He's also here as well for the 80th IATA AGM, which is going to be taking place here at the start of next week. But John, you bring up a couple of stories actually. You bring up what's happening with Boeing, but you also bring up the issue that we had earlier on in the week with the American numbers and the impact that that had on the rest of the sector. Ed, great to see you. Congratulations on the award, first of all.
Well, thank you, Guy. It's good to be with you. It's good to be in Dubai, and really proud of our team.
Yep.
Their ability to continue delivering outstanding results for our customers is what makes these awards, first of all, very humbling to receive, but hungry to continue to win them.
Yep, you got to keep it up, don't you?
You got to keep it up.
Let's talk a little bit about kind of what is happening in the market right now and those customers that you talk about. We did see the American downgrade in terms of its guidance a few days back. I'm not going to ask you to comment on what is happening over at American, but really just to kind of get a comment on whether you're comfortable with your current guidance.
Yeah, the demand has been really strong. I think that was the issue, that with the American numbers and the quarter, as we've indicated all along these last several years, that consumer demand and that priority to invest in experiences continues to be really, really healthy. June for us is always the largest travel month of the year, of the calendar, so we still have to see how June's going to go, but I'm confident it'll be a good result for the full quarter, and we'll see how June runs out.
Are you seeing any evidence that inflation, and it's inflation day, we're going to be watching those numbers, that inflation is starting maybe to hit the middle-class traveller, that the middle-class traveller is beginning to rethink maybe the attitude towards travel, which has been really strong over the last few years?
I don't see it. Our consumer tends to be at the upper end of the income scale. Our traveler tends to go internationally. Our consumer is prioritizing travel above things. So while you may be hearing from a number of industrial sectors, trade downs occurring, we're not seeing that in our numbers.
Do you think you will see that at some point? Do we go to a more normal? Is this the new normal in terms of what travel is going to look like? Will this continue to persist? The stock market continues to do very well. We're obviously seeing an upper-end consumer that is still fairly flush with cash. Is that something that lasts years?
I think it's going to continue for quite a few years to come. One of the factors people don't give enough consideration to is our industry's capacity is lower than it's been, given the constraints around OEMs, whether it's Boeing or engine issues. So our economy is a lot larger than we were historically, go back pre-pandemic, yet the amount of capacity that we're all able to fly is significantly constrained. And that's what's keeping demand as well as pricing pretty strong.
Okay, pricing. So fares are still fairly robust, are they?
Yeah. Fares on balance are about 20% higher than they were pre-pandemic.
You bring up business travel as well. Is that something that it has come back? It's maybe come back significantly more slowly than we've seen in terms of the retail story. But is that coming back? And ultimately, given that bigger economy, is that a bigger number some way down the road?
Well, business travel this year, particularly in 2024, has really stepped up. As we went through the return from the pandemic in 22 and 23, business travelers were still a bit sluggish, largely because they weren't back in their offices and they were still working from various remote locations. Once companies have finally laid the edict down, you needed to get back. And particularly as some of those businesses started getting a little challenged themselves, people wanted to be back in the office. That opened up the need to travel for consultancies to go visit clients, for people to get back out on the road to see their own people. So we've seen we saw about a 10-point increase in business travel at the start of the year, and that's continuing to climb.
Middle of the top line, okay, so we talked about that. That's looking good. Middle, what's happening in the middle of the P&L? Are you still seeing, what kind of inflation are you seeing in the business?
We're seeing inflation, but it's starting to moderate a bit. For us, the biggest part of our inflation story is wages, is our people, which that's the best type of inflation we can have, and our people continue to grow wages in the 4 to 5% per annum rate. We're continuing to work on productivity and efficiency so we can take some of those rates and make certain that they're productive increases. Other parts of the supply chain, where the supply chain is still not where it needs to be. We talked about the engine issues. We still don't.
How much is that holding you back?
Well, it's significantly. Again, it's not just Delta, it's the industry. And the turn times are longer. You now have turn times on planes that could extend up to months rather than weeks, which they should be. Parts are higher than ever. Material costs are growing. The manufacturers across the industry are having challenges.
This doesn't sound like an economy that you're describing that needs rate cuts right now.
Well, it's an economy right now, from my standpoint, that's doing well. But there's not just one consumer out there, right? Our consumer, again, tends to be in the upper end. Our consumer generated a tremendous amount of wealth and continues to have that wealth through the pandemic. The market's up, real estate's up, unemployment is extraordinarily low.
They don't need more help, is basically what you're saying.
The lower end, I think there's some challenges. So that's something that the Fed will look at all the data. I don't think an airline is necessarily the indicator.
You've got a pretty good view of what's happening in the economy.
Yeah, our business is doing quite well.
Okay, you bring up Boeing. You talk about what's happening with the OEMs, Boeing and Airbus, but it's also the engines, as you mentioned, the Pratt & Whitney engine issues that we've been seeing. How long does this last? How much of a struggle is it to get hold of the kit that you need right now? How long do you think the problems that we're seeing at Boeing and Airbus and Pratt & Whitney are going to be lasting for?
Well, right now we have no Boeing orders that we're anticipating delivery on in the next several years. So from our standpoint, it's really an Airbus story. Airbus has been a great partner. And Airbus continues to provide us the planes and the technology that we've been expecting for them, and they were right through the pandemic. The engines are going to be a bigger issue, particularly for us, the geared turbofan. That's slowing down a little bit about the amount of new deliveries that we can take, but it's more engines than it is planes. And what it's causing us to do is maintain the existing fleet we have a little bit longer, so that's another cost to the business.
You are well known for keeping your fleet for longer. It had the age of the average aircraft has come down a little bit over the last few years. But does that strategy work in an environment where the sustainability question comes in? If you fly older planes, they inherently tend to be less efficient. Is that a problem that you're going to come across at some point?
I don't think so. Again, I think this is transitory. I think the OEMs will get their parts. I think they will get the transition. Again, a lot of this is about labor and the fact that many of the engine, not just the tier 1, but down into the tier 3 and tier 4 of the supply chain, let a lot of people go. So it's experience, it's staffing, it's rates. I mean, it's a very complex story. But long term, I feel good about our sustainability story. We're taking our overall footprint down in the range of 1 to 2% per year, every year, and that's going to continue to go on. And as we get new planes, those numbers are going to go down faster.
Politics is going to become a bigger and bigger issue over the next few weeks and months as we approach November. When you think about who goes next to the White House, what does the next administration need to do to keep the aviation market that you've just described, this buoyant market, this market with momentum, keep it going? What do you need to see from the next administration to keep it on track?
Most important thing is infrastructure investment. Maintaining the current structure is challenging, and they need to continue to modernize the technologies. They continue to need to get air traffic controllers staffed and hired and in position to enable us to grow. And from an investment standpoint, that's where we're very happy to see the FAA reauthorization bill finally come about. It took, unfortunately, months, if not a year overdue in its delivery, but it's here now, and we're going to work closely with the FAA to make that happen.
Just to wrap the conversation up, you feel like you are on the front foot at the moment. This is an airline that is growing. What is the capacity constraint that you are seeing right now that is going to slow your rate of growth down? If I'm an investor looking at Delta, is this as good as it gets, or does it get better from here?
We're doing well on capacity growth. This year we expect to grow our top line in the mid single digits, in that 4 to 6, 7% range, which I think is healthy growth considering particularly the growth we've had over these last handful of years. This year will be the highest revenues in our company's history. It's quarter of $60 billion plus or minus. And the outlook, I think, is strong because I think the supply chain and the constraints are only going to get a little bit better as we move forward.
Ed, congratulations on the award, the ATW award that you'll be getting here in Dubai this evening. Great to see you here in Dubai.
Great to see you.
Thanks for stopping by to see us here.
Thanks, Guy.
Bloomberg.
Great to be with you.
Thank you very much. John, from Dubai, back to you.
Thank you, buddy. Great to catch up and hear that conversation. Guy Johnson there with the Delta Airlines CEO, Ed Bastian.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.